Welcome to the Three Edge Week in Review for the week of June 7th, 2021. I'm Fritz Folts, Chief Investment Strategist here at Three Edge, and I'm joined here once again today by Steve Cucchiaro, President and Chief Investment Officer at Three Edge Asset Management. Today, along with a brief update of the global capital markets, Steve and I will be discussing our topic for this week, which looks at investing in a post-pandemic world and the newfound spirit of YOLO. But before we get into that, a brief market update. It was a bit of a mixed week in the equity markets, though the S&P 500 index managed to reach yet another all-time high on Thursday in spite of the fact that the Bureau of Labor Statistics reported that consumer prices here in the U.S. had increased by the most in over a decade. Investors seemed to take comfort in the minutiae of the data, which showed that increase in consumer prices were driven largely by the categories associated with reopening of the U.S. economy, thereby reinforcing investors' view that inflation pressures may ease later in the year. However, investors will now turn their focus to next week and the meeting of the Fed's FOMC to see if the Fed may provide any clues about its next moves with regards to asset purchases and interest rates. Interestingly, even with elevated CPI print higher than expectations, yields on the 10-year U.S. Treasury declined after the report was published, indicating that the bond market is still taking the Fed at its word, believing that it will not be tapering its easy monetary policies anytime soon, even in the face of rising inflation. So the ongoing tension in the markets continues, and it is two competing forces. On the one hand, a robust economic rebound from the global pandemic, while on the other hand, investors' fears that inflation may not be so temporary and the Fed may already be falling behind the curve when it comes to taming the inflationary pressures still to come. So, Steve, we're going to talk about investing in a post-pandemic world. And as the world emerges from the coronavirus, it does seem clear that, at least for now, the consensus among most investors is that post-pandemic, our lives will go back to normal. And normal in this case means that everything will be the same as it was, I guess, back in the fall of 2019, prior to the onset of COVID-19. However, I know that you have some doubts about that forecast. And here at Three Edge, we believe that it's at least worth considering and preparing for the possibility that there may be some longer lasting and even more permanent changes to our way of life in a post-pandemic world. And these changes could impact the global markets in the future. So maybe you could talk about that and let us hear your take on the post-pandemic environment.
Well, I think you're right, Fritz, that there's reason to doubt the consensus, or at least hold out the possibility that the consensus is wrong. There are examples in history when there was a longer lasting shift in behavior that occurred after an event similar to what we just went through with the pandemic. And to paraphrase Mark Twain, history doesn't exactly repeat itself, but often it rhymes. And I can think of a couple of situations. One is after World War I, and then the last great global pandemic we had, which was the Spanish flu, right, in 1918, 1919 timeframe, we did have a lasting shift in behavior. And the first effect of that was a big rebound in the economy. And this was globally, not just in the US. And then we had a big surge in inflation beyond what anyone expected. Eventually, interest rates followed that. And then we had a huge market correction from very high levels. But the behavior continued, and we have what we now know as the Roaring '20s, and that continued to build excesses in the system until we had the crash of '29. Another period, after World War II, we had some strong similarities to now. We had the World War II, which was a very, very intense and traumatic experience, like we just went through a pandemic that was an intense experience. We had record levels of debt, and now we're back into record levels of debt, even higher as a percent of GDP than in World War II. We have very low interest rates, very low inflation like now. Mm-hmm. No one expected inflation to go anywhere. And after World War II ended, in a 6-month period, inflation went from under 2% to over 8%. As the behavior of people shifted and caused this inflation to go up. People thought it was temporary back then, but it persisted. And for a 3-year period, we had inflation in the high single-digit to low double-digit range. So yes, it can go on.
All right. So now let's switch gears and look at the post-pandemic world, beginning with an acronym, which I mentioned at the beginning, And the acronym is YOLO, which stands for You Only Live Once. Now, on the Wall Street Bets site, the term is used to describe a trader who goes all in on a stock, but that's not what we are talking about here by YOLO. What we're describing is that after such a devastating year plus, so much human tragedy, so many people literally locked down in their homes or apartments for a year or more, people have really taken the time to reevaluate their lives. And so I guess it is worth considering that if this spirit of YOLO becomes a driving force in people's lives for more than just a few months post-pandemic, we could see pickup in money velocity, which could be inflationary, and maybe that could last a lot longer than the current consensus view and be one of the many unintended consequences of the population emerging from the pandemic. So what might this mean for the capital markets?
So after a traumatic experience like a world war or like a global pandemic, human behavior can change for an extended period. And it's the idea that people realize life is fragile and they don't take things for granted. And perhaps no longer should they postpone the things that they would like to do.
Mm-hmm.
And maybe it's time to go on that vacation that you always talked about but put off for another day, or revisit the favorite restaurant or bar, or buy that car you always thought about buying but postponed, or that vacation home or beach home. And yeah, go ahead and borrow money. The government's borrowing so much money, interest rates are at record lows, and you only live once. Go ahead and do it.
Mm-hmm.
Or maybe it's time to change that job that you weren't so happy with, and either ask for more money to take on the same job, or switch jobs and try to get more money for working. So all of these can last more than just some small transitory period. Now, the real difference between the possibility for inflation now and what we saw after the global financial crisis of 2008 is that the nature of the stimulus now is fiscal, meaning government spending. And unlike the monetary stimulus that we had after the financial crisis, where the Fed created the stimulus, but a lot of that just inflated asset prices and stayed in the financial system, government is putting money directly in the hands of consumers in the real economy. And this means that demand, real consumer demand, can go up, and people have the means to do that. And this is what could change the money velocity, which was going down. It fell from a peak right before the financial crisis started to a bottom just shortly recently, just some time ago. And now it's got a chance to rebound, and no longer do you have that neutralizing effect, the big increase in the monetary base that we've had. So rather than being temporary, this could be longer lasting. Now, it is true that this creates some bottlenecks in supply, and people are right to point out that some of these are transitory. Some of these will get solved quite quickly, no question about it. But there are also other products and services that will be, the inflation rates will be longer lasting. An example, energy. Now, more and more people are driving or flying, or factories are using more demand and more electricity and more energy. And unlike the past, right now there's very little incentive for big oil companies to invest lots and lots of money in new plant and equipment that will take years to pay off, when there's so much pressure from social investing and environmentally conscious investing to not create any more capacity for fossil fuels. And so, unlike before, we could have rising oil prices, rising demand, but not the supply to meet them. So this could be longer lasting, and energy prices feed into many, many goods and services. Semiconductors, technology has been a deflationary force, but now it can be partially inflationary, because semiconductors are a central part of almost everything in technology and in cars and in defense and so on. And it takes years and billions of dollars to create more capacity for semiconductors.
Right.
Another sticky component is food. And food is going up not just because of short-term demand or supply restrictions, but droughts and climate change. And these are issues that won't go away anytime soon. And when people find their food bills are going up and their energy bills are going up, they feel that, and they change the psychology, and they might demand more in wages, et cetera. Now, the irony is that the Federal Reserve Board has a preferred inflation indicator that's called core inflation, specifically by design excluding food and energy. And so, ironically, the Fed will be the last to see that food and energy might be affecting change in psychology.
Very good. Now I want to ask you something actually very specific, and this is that, as I mentioned earlier, this week we saw the latest report of inflation from the Bureau of Labor Statistics showed that this consumer price index had rose more than consensus and the most in well over a decade. And yet, the yield on the 10-year Treasury actually declined to its lowest level since March. And I think for a lot of investors, this is a bit of a head scratcher, you know? So what do you think is going on here? I mean, I suppose it means that the bond market is on board with the Fed's thinking that inflation will be transitory and they won't be tapering anytime soon. But is there more to it than that? What are your thoughts about that?
So on the surface, the first impression that people get is the market believes the Fed. The market believes the economists who all say inflation is transitory. And they use their linear models where they treat the economy as a linear system at equilibrium. Mm-hmm. And they extrapolate recent trends, all to say, yes, this is just a temporary blip and it's all going to go back to normal. Now, I like to point out that the track record shows that economists as a rule and the Fed as a rule has had a very poor track record predicting inflation, especially at turning points. And it's not because they're not really intelligent and experienced at it. It's because they don't treat the global economy and the markets as a complex adaptive system, which with a small change in an important input can completely change its behavior. And so right now, the potential change in the behavior so that it's not right to just extrapolate from the past is that psychology can change like that. Psychology can change money velocity. Money velocity can completely change the equations of the dynamic that could cause inflation to go up. So that's, in our view, very important to know. Now, the other thing is that some of the best investment opportunities over time come when the consensus is wrong. When the market all believes a certain outlook, a certain outcome is going to happen, then if it proves wrong, that's when there's a big opportunity to bet against the grain and to either protect yourself and other people are getting hurt or to take advantage of investment opportunities that other people don't see. One other point, a lot of people are saying that it's proof that inflation is transitory because the bond yields are going down. I want to point out another factor that's very important. There's a tremendous amount of manipulation of the bond market that has nothing to do with inflation forecasting. And an example of that is that right now we have investors buying bonds, not so much because they think inflation is going down, but because they're forced to, given regulations. In fact, we have a period now where a lot of the foreign investors that were big investors in the bond market are actually backing away and buying fewer and fewer bonds. The Fed, the Federal Reserve Board, has stepped in and is now buying more than half the bonds that the government is issuing. Well, who's buying the rest? Well, a lot of those are being bought by banks and certain hedge funds and other investors that are forced to buy Treasury bonds because they're forced to, by regulations, to build up their collateral that's backing all of their more risky derivative bets or all the cash that's being created by the Federal Reserve Board with all their money printing that's sitting in the banks. So a lot that's going on that's affecting the bond market has nothing to do with inflation, but people are making the simple leap that, oh, it must be that inflation's not coming back. So we think there's an opportunity here, and we're very careful to understand that it would be too dangerous now to just assume inflation is going away. There is a chance inflation is coming back on a more sustained basis. We're going to make sure we do everything we can to protect our clients accordingly.
Excellent. Really good explanation, and you cut right through the noise with that. So thank you. So that will do it for us. Steve and I will be back next week with another edition of the 3 Edge Week in Review. And remember, all of our videos are available on our 3 Edge YouTube channel, as well as on our website at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3 Edge, we want to thank you for listening, and we'll see you next time.